Okay, let's unpack this. Have you ever looked at the stock market, all the headlines, the charts, the jargon, and just felt, well, completely lost?
Oh, absolutely. Like it's this impenetrable fortress just for finance pros.
Exactly. You're definitely not alone there. We've got this really interesting stack of sources here, and they're all about, pulling back that curtain, understanding and navigating the market.
Hmm.
This deep dive is really tailored for you, the listener, if you're someone who wants to get a clear handle on it all without feeling totally overwhelmed.
Precisely. Our mission today, looking at this material, is to sort of distill the most important bits.
Hmm.
We'll start with the absolute basics, then move through different ways to analyze stocks.
Setting goals, too, right?
Yes, setting your personal goals, and crucially, how to protect your investments along the way.
Think of the stock market less like a fortress, maybe more like a huge ecosystem. It's complex, sure, but understanding the basics is genuinely key for making smart decisions about your own money.
It really is the essential first step. I mean, at its heart, the stock market is just a marketplace. But instead of apples and oranges, people are trading shares of companies,
Yeah.
publicly listed ones.
Shares, meaning ownership.
Exactly. When you buy a stock, you're buying a tiny slice of ownership in that actual business.
Right, so those shares represent a claim on the company's stuff, its assets, and maybe its earnings, too. And the sources mention common versus preferred stocks, slightly different flavors of ownership.
That's right. Different rights attached.
Yeah.
And all this buying and selling happens on organized platforms, exchanges, like the big ones. Everyone knows the NYSE, the NASDAQ.
Okay. And a term that pops up right away is market capitalization, or market cap.
Yeah, that's a big one. It's basically the total value of all a company's shares put together. You just multiply the stock price by the number of shares out there.
And that's how we get labels like large cap, mid cap, small cap.
Exactly. It gives you a quick sense of the company's overall size, its scale in the market.
Got it. Then there are dividends. That's another potential benefit of owning stock, right?
Hmm. It's when a company decides to share a portion of its profits directly with its shareholders. Often happens quarterly.
But, and this is important, not all companies do pay dividends.
No, definitely not.
Mhm.
Some prefer to reinvest all their earnings back into growing the business itself,
Hmm.
which can also be good for the stock price long term.
And how people actually do the buying and selling. That's trading or investing.
Right. The sources cover different approaches.
Mm.
You've got really short-term stuff like day trading, swing trading, all the way to long-term investing, buy and hold.
And each has very different strategies
Yeah.
and risks.
Hugely different risks, yeah.
The material shared a great example, Sarah. Just starting out, kind of jumped into popular tech stocks based on buzz.
We've all been tempted, right?
Totally. But she felt lost, didn't really get market cap or stock types. But the key point was, after she took time to learn these basics.
The light bulb moment.
Exactly. She didn't just know the terms, she actually felt confident, like she was in control of her choices.
That story is perfect. It shows that learning this stuff isn't just academic, it's really practical. It's what lets you handle the market's ups and downs with, well, less panic.
So the sources really stress why this knowledge is so vital.
Yeah, it's not just nice to have.
First off, informed decision-making. There's so much noise out there, right? Predictions, news flashes.
Endless noise.
Knowing the basics helps you filter it, figure out what actually matters for you.
And it's absolutely fundamental for risk mitigation. Look, investing always has risk. No way around it.
Always.
But understanding how things work lets you see potential risks and take calculated ones, not just, gambling on a tip.
Which leads directly to crafting your own investment strategy. If you know the building blocks, you can build a plan that fits your goals, your timeline, your comfort level with risk, not just copying someone else.
Mm-hmm. And it helps you understand market trends and indicators. Like knowing how interest rates might affect stock prices gives you context. Helps you make better timing decisions, maybe.
Or know when to be a bit more cautious.
Percent.
And ultimately, the sources say, this knowledge helps you actually achieve your financial goals. Retirement, education, a house, whatever it is. Understanding how the market works helps you use it effectively to reach those goals.
Yeah, the material really drove home how this foundation builds investor confidence. You used another example, John. He was totally overwhelmed at first. Hesitant.
Paralyzed, almost.
Kinda, yeah, because he felt he didn't know enough. But the turning point was actually learning about investments, strategies, how markets behave. He went from frozen to actually making a plan.
A long-term plan.
Yeah, and building his portfolio steadily,
Yeah.
confidently. It's a powerful shift.
It really is, from apprehensive to purposeful. And it's doable. The sources list resources, classic books like Graham's or Malkiel's, online courses, podcasts, blogs.
Even market simulators. Practice without real money first.
Great idea.
Think of it like learning a new language, maybe the language of finance. You don't become fluent overnight, but learning the basic grammar lets you understand and eventually, write your own financial story.
It's that essential first step, moving from feeling lost to feeling empowered.
Exactly.
Okay, so once you've got that basic understanding starting to build, the sources are super clear. The next big step is setting your compass. You need clear, achievable goals.
Absolutely critical. Just saying, I want to make money in stocks is, well, pretty useless, frankly.
Too vague
Hmm.
leads to vague results.
Right. Setting clear objectives gives you a map. It guides every single decision you make from that point on.
And there are pieces to making those goals effective, right? First, defining your why.
Yes. What's the actual purpose?
Yeah.
Retirement way down the road?
Mhm.
A house deposit in 5 years?
Yeah.
College funds starting in 10? Each why needs a totally different strategy, different timeline.
Then specificity makes a huge difference.
Oh, massively. Save for a down payment is okay, but save $50,000 for a down payment in 5 years that you can work with.
It gives you something concrete, measurable.
Which leads to the next point, measurable benchmarks. With the specific goal and timeline, you can set mini goals. Maybe how much to save each year or each month. Lets you track your progress.
Keeps you on track. And adaptability.
Yeah, super important. Life happens, right? Your situation might change. Or maybe a strategy just isn't working out.
You need wiggle room.
Exactly. Building in flexibility means you can adjust your plan without feeling like you've failed. You just pivot.
The sources mention Laura, who set a really clear goal. $1 million by age 50. Ambitious.
Very, but powerful.
Because it wasn't just a wish, it translated directly into actionable steps she needed to take each year. Made it a structured plan, not just a dream.
Clear objectives really are the anchor. And tied right into them are two other crucial factors, your time horizon and your risk tolerance.
Time horizon. That's just how long until you think you'll need the money back.
Pretty much, yeah. The length of time you plan to stay invested. And the sources break it down, short, medium, long term.
And that time frame really dictates the type of investments you might look at.
Definitely. For short-term goals, say 1 to 3 years maybe saving for a vacation, emergency fund, the sources strongly suggest sticking to low-risk options. Savings accounts, money market funds, maybe short-term bonds. Capital preservation is the name of the game.
Makes sense. You don't want that money disappearing right before you need it.
Exactly. Medium term, maybe 3 to 10 years out, saving for college, a down payment further down the line, you can maybe afford a bit more risk, aiming for some growth.
So a mix. Yeah.
Perhaps a mix of safer stuff and some equities like balanced mutual funds or ETFs.
And then long-term goals, 10 years plus. Retirement, usually.
Right. Retirement legacy planning. Here, you've got time on your side, time to potentially ride out the market's bumps. So the sources suggest you can lean more towards growth, primarily through stocks, which historically have offered better returns over those long periods.
Okay, so time horizon is one piece. The other is risk tolerance.
Ah, yes. This one's personal. It's your ability, and maybe more importantly, your willingness to handle the ups and downs, the volatility.
How much you can stomach watching your investments fluctuate.
Exactly. And it's shaped by lots of things: your age, your financial situation, your past experiences, even just your personality, your emotions.
The sources describe it kind of like a spectrum.
Yeah. On one end, you've got the conservative investor. Their main goal is just protecting their initial capital. Returns might be modest, but safety first. Think government bonds, high-quality corporate bonds.
Then maybe moderate.
Moderate investors are okay with some ups and downs, some volatility, in exchange for potentially better growth. They'd likely have a balanced mix of stocks and bonds.
And aggressive.
Aggressive investors are willing to take on significant risk, embrace that volatility, hoping for much higher returns. Their portfolio would be heavily skewed toward stocks, maybe even riskier sectors like tech or biotech.
The example of Mark, the recent grad, fits here. Long time horizon, decades till retirement.
So he felt comfortable being more aggressive.
Right. Taking on higher risk with mostly stocks, aiming for that long-term growth potential, knowing he likely has time to recover from any dips along the way.
How do you figure out where you fit on that spectrum, though? The sources suggest a few things. Risk assessment questionnaires can help.
Financial advisors often use those.
They do.
Yeah.
Also, just honestly looking at your financial health and goals, your time horizon, is a big factor here. And crucially, understanding your emotional reaction.
Like, what do you do when the market tanks?
Exactly. Do you panic sell? Or can you stay relatively calm, maybe even see it as an opportunity? That gut reaction tells you a lot about your true tolerance.
That emotional piece is fascinating. So, nailing down clear goals, knowing your time horizon, and getting real about your risk tolerance, that's the foundation.
Absolutely. It turns investing from something vague into a path designed specifically for you.
Okay, foundation laid. Now, how do you actually pick potential investments? This brings us to analysis, right? And the sources cover two main types, starting with fundamental analysis.
Right. Fundamental analysis is like being a detective for a company's business.
Hmm.
It's all about figuring out a stock's intrinsic value, what the company's really worth based on its actual health and future prospects.
Not just the current stock price hype.
Exactly. You dig into the company's financials, and you also look at the bigger economic picture it's operating in.
And the main tools for that digging are the financial statements.
Yes, the big three. First, the income statement. Think of it like a performance report over a period, quarter, or year. Shows revenue coming in, expenses going out, and the bottom line. Net income or profit.
The sources used a coffee shop analogy. Revenue going up is good, but if costs are rising even faster...
Right, then profitability might actually be shrinking. Even if sales look great, need to look deeper.
Okay. Then the balance sheet.
Balance sheet is different. It's a snapshot in time. Shows what a company owns its assets, what it owes liabilities, and the difference, which is shareholder equity, what belongs to the owners.
And you look at ratios from this, like the current ratio.
Yeah, current ratio checks if it has enough short-term assets to cover short-term debts. Good sign of health. Debt to equity shows how much debt the company is using compared to its own capital, how leveraged it is.
Got it. And the third one is the cash flow statement.
Super important. This tracks the actual cash moving in and out, not just accounting profit, but real money, broken down into operations, investing activities, and financing.
Why is that so crucial?
Well, the tech company example in the sources was great. It might show high earnings on the income statement, but the cash flow statement could show it's actually burning through cash really fast, maybe on R&D.
So profitable on paper, but maybe struggling to pay the bills.
Potentially, yeah. Negative cash flow can be a warning sign about sustainability.
Okay. Beyond the statements themselves, there are financial ratios that kind of summarize things.
Right, quick insights. The PE ratio, price to earnings, is everywhere. It tells you how much investors are paying for each dollar the company earns.
High PE means high expectations. Low means maybe undervalued or maybe problems.
Generally, yeah, it's a valuation clue. Then there's return on equity, ROE. Measures how well the company uses shareholder money to make profit. Higher is usually better.
And EPS, earnings per share.
Simple but key. Profit divided by the number of shares tracks performance per share over time.
The sources mentioned Emily, who really dug into these statements and ratios consistently.
Yeah, it wasn't just number crunching for her. It was about understanding the business health.
And it helped her avoid some potential pitfalls.
Exactly. Avoided companies with weak financials, built a more solid, diversified portfolio because she understood the fundamentals.
But fundamental analysis isn't just the company, right? It's also the bigger picture.
Absolutely. You need to understand the economic indicators, the environment the company lives in.
Like GDP, gross domestic product.
Yeah, the total value of everything produced. If GDP is growing, the economy is generally humming, businesses often do better.
And inflation. The rate prices are going up.
Right. A little inflation is normal, maybe even healthy, like around 2%. But high inflation eats away at purchasing power, can hurt consumer spending, and squeeze company profits.
Unemployment rate, too.
Key indicator. High unemployment signals weakness, less spending. Low or falling unemployment suggests confidence, more activity.
And interest rates, set by central banks like the Fed.
Crucial. Low rates make borrowing cheap, encourages spending and investment. High rates do the opposite, slow things down. Designed to manage economic growth.
The example of Michael, the investor who watched inflation.
Yeah, he saw inflation rising and thought, maybe people will cut back on non-essential stuff.
So he adjusted his portfolio, moved away from those consumer-driven sectors.
Proactively, yeah.
Yeah.
Based on understanding that broader economic trend.
Where do you find this data? Government reports?
Government reports, research groups, financial news outlets, it's widely available. Staying informed provides really valuable context for your company analysis.
Okay, so fundamental analysis is the deep dive into value, financials, the economy. What's the other main approach? Technical analysis.
Exactly. If fundamental analysis is about what to buy based on value, technical analysis is more about when to buy or sell, based purely on price action and market trends.
So it's not looking at the company's balance sheet at all?
No, it uses historical price and volume data, assuming that patterns repeat and market psychology influences price movements.
Studying the market's footprints, basically.
And the main tool is charts.
Charts are central, yeah. The sources mention a few key types. Line charts are the simplest, just closing prices over time. Good for a quick trend visualization.
Bar charts give more info.
A bit more.
Yeah.
Each bar shows the open, high, low, and close price for a period. Helps see the trading range and volatility within that period. And candlestick charts, those seem really popular.
Very popular, visually quite rich. Each candlestick shows the open, high, low, close too, but the body is colored or filled to show if the price went up or down. Makes spotting trends and patterns easier for many people.
Like Jake in the sources, he found them more intuitive.
Yeah, initially overwhelmed by charts, but candlesticks clicked for him. Helped him start seeing potential bullish upward trends or bearish downward ones just from the visual patterns.
And speaking of patterns, technical analysis looks for specific shapes on these charts.
It does. Common patterns that traders believe can signal future moves based on how they've played out historically. Like the head and shoulders pattern,
Sounds ominous.
often seen as a reversal pattern, yeah. Suggesting an uptrend might be ending and turning down.
What about double tops and bottoms?
Those suggest price hitting a ceiling, resistance at the top, or a floor, support at the bottom, and potentially reversing. Double top might signal a move down, double bottom a potential move up.
And triangles.
Triangles usually show the price consolidating, getting tighter, before potentially breaking out either up or down. The type of triangle might hint at the direction.
So for Jake, learning these patterns wasn't just theory.
No, it gave him actual signals, potential entry points, maybe after a double bottom formed, or exit points if a head and shoulders appeared. It boosted his decision-making confidence based on the chart signals.
Beyond just looking at patterns, there are technical indicators, math calculations.
Right, mathematical formulas applied to price or volume data, plotted on the chart. They're meant to add clarity or provide extra signals.
Moving averages are a big one.
Fundamentally, yeah. They smooth out the price data into a line to show the trend more clearly. SMA is simple average. EMA gives more weight to recent prices, so it reacts faster.
And traders watch for crossovers? Short-term average crossing a long-term one?
Often used as potential buy or sell signals, correct?
What about RSI? Relative Strength Index.
That's a momentum indicator. It goes from 0 to 100. Readings above 70 are often considered overbought. Maybe the price ran up too fast and is due for a pullback. Below 30 is oversold. Maybe it fell too far too fast and could bounce.
And Bollinger Bands. Those look like expanding and contracting bands around the price?
They do. Middle band is a moving average. Outer bands show volatility. When bands squeeze tight, it might suggest a big move is coming. Price hitting the outer bands can also signal overbought or oversold conditions.
Okay. And MACD. That sounds complex.
Moving average convergence, divergence. It shows the relationship between two different moving averages. Often, traders watch for the MACD line crossing above or below a signal line as potential buy or sell triggers. Bullish cross above, bearish cross below.
Sarah, who learned the basics earlier, started using RSI.
Yeah, after getting comfortable with charts, she added RSI. The forces mentioned, she spotted a stock looking overbought based on RSI, combined it with her other analysis, decided to sell.
And it worked out. The stock dipped.
It did, yeah. Reinforced for her how these tools could be practically useful.
Any tips from the sources on using this stuff effectively?
Key ones are, don't rely on just one indicator. Combine a few for confirmation. Always backtest your strategies on historical data to see if they even work in the past. And stay flexible, markets change. Indicators can give false signals.
So technical analysis is another tool in the toolbox. Complementary to fundamental analysis, helps with timing, understanding momentum.
Exactly. Useful for short-term trading, but even long-term investors might use it to fine-tune entry or exit points.
Which brings us to something absolutely critical, no matter your approach: protecting your journey, risk management, and diversification.
Paramount.
Yeah.
You absolutely have to think about managing risk. The market is unpredictable. You need strategies to protect yourself from potential losses.
So risk management, that's about being proactive, identifying risks.
Identifying, assessing, and then prioritizing them. Yeah. Trying to minimize the potential negative impact. It's not about avoiding risk entirely. You can't investing, but managing it intelligently.
What kinds of risks are we talking about? The sources mentioned market risk.
Right, or systematic risk. That's the risk of The whole market going down due to big events, economic recession, geopolitical crises, just overall bad sentiment. You can't really diversify this one away completely.
Then there's credit risk. More for bonds.
Yeah, the risk that the entity you lent money to by buying their bond might not pay you back. Default risk.
Liquidity risk. Being stuck with something.
Kind of. It's the risk you can't sell an asset quickly when you want to, without taking a significant price cut. Less common with major stocks, but can affect other assets.
And operational risk. Things going wrong inside a company.
Exactly. Failures in their systems, processes, even human error that negatively impacts the business.
Lisa's story in the sources really hammered this home. She jumped in early, high-risk stocks, no real risk plan.
It got burned in a downturn. Significant losses.
A tough lesson.
Yeah.
But it highlighted just how crucial it is to think about risk before things go wrong.
Absolutely. So what can you do? Key risk management strategies. Setting stop-loss orders is one.
That's an automatic sell order if the price drops to a certain point.
Right. Helps cap your potential loss on that specific investment. Doesn't guarantee it, especially in fast markets, but it's a common tool.
Position sizing sounds important too, not putting too much in one thing.
Critically important. Deciding how much of your total capital to put into any single investment based on its risk and your overall portfolio size means one bad bet doesn't sink your ship.
Stress testing. Simulating bad scenarios.
Yeah, seeing how your portfolio might hold up if the market suddenly drops, say, 20% or 30%, helps you spot weaknesses beforehand.
And regular review and rebalancing. Checking in periodically.
Essential. Maybe once or twice a year, look at your holdings. Have things gotten out of whack with your target allocation? Maybe stocks have soared and now make up too much of your portfolio.
So you sell some of the winners and buy more of the underperformers.
To bring it back into balance with your original plan and risk tolerance, it enforces discipline.
Lisa, after her rough start, started doing these things. Stop losses, regular reviews.
She did. Implemented stop losses, started rebalancing regularly. It gave her more control, helped her manage potential losses much better, made her more aware of her overall risk exposure.
And probably the biggest risk management strategy of all, diversification.
The classic. Don't put all your eggs in one basket. It's fundamental. Spreading your money across different types of investments.
Because they don't all move in sync.
Right. That's the key idea.
Yeah.
Different assets, different sectors, different geographies tend to react differently to market events. When one part of your portfolio is down, hopefully another part is holding steady or even up, smooths out the ride.
So effective ways to diversify. Asset class diversification.
Yeah. Mixing stocks, bonds, maybe commodities, real estate. Each has different risk-return profiles, so combining them creates balance.
Sector diversification within stocks.
Right. Investing across different industries, tech, healthcare, energy, consumer goods, financials. If tech takes a hit, maybe your healthcare stocks are doing fine, cushioning the blow.
Geographic diversification.
Right.
Investing outside your home country.
Important too. Reduces risk tied to just one country's economy or politics. Lets you tap into global growth opportunities as well.
And time diversification. That's dollar cost averaging.
Often achieved that way, yes. Investing a fixed amount regularly, like every month, no matter what the market's doing.
So you buy more shares when prices are low, fewer when they're high.
Exactly. It averages out your purchase price over time and reduces the risk of investing everything right at a market peak. Helps manage volatility.
And Lisa eventually really embraced this.
She did. Broadened her portfolio way beyond just those few tech stocks. Added bonds, REITs, real estate investment trusts, international stocks.
Reduce the overall swings.
Significantly. And using dollar cost averaging helped her mentally weather the ups and downs too, build a much more resilient portfolio.
So risk management, diversification, they aren't just optional extras. They're absolutely core to protecting what you build and staying on track long term.
Couldn't agree more. Absolutely fundamental.
Wow. Okay. We've covered a lot of ground here, really digging into this material. Started with the absolute basics, what the market is, why knowledge itself is power here.
Getting that foundation to combat feeling overwhelmed.
Then setting that personal foundation, your goals, your time horizon, your real comfort level with risk. So crucial for direction.
Absolutely. The why and how long and how much risk shape everything else.
We looked at the two main analysis toolkits. Fundamental analysis for digging into value and economic health.
And technical analysis for reading the charts, the trends, the price action. Two different lenses.
And wrapped up with the essential armor, proactive risk management, and the power of diversification to build resilience.
Protecting your journey along the way.
The big message cutting through all of this seems to be knowledge really is the key, isn't it? It's what lets you navigate this complex world with clarity, with
That
confidence.
really is. It empowers you to move from maybe feeling intimidated or just guessing to making purposeful decisions that actually align with your life, your path.
Because all these pieces, the analysis, the goals, the risk management, they don't work in isolation. They weave together.
They absolutely do. To create a strategy that's truly customized for you and your specific aspirations,
Ah.
hopefully leading to better results in the long run.
So, thinking about everything we've discussed today, personal goals, time, risk tolerance, fundamental value, technical trends, managing risk, diversifying, how does bringing all of that together create a unique path just for you, the listener? And maybe just ponder this. Based on your own situation right now, what's one specific element out of all of these that you feel is most important for you to explore further or maybe start implementing next?